Hello, and welcome to the latest Expert Series webinar. Today's webinar is Fixed Income in Focus, Rising Rates, Misconceptions, and Solutions. This is a complimentary IndexUniverse webinar courtesy of Guggenheim Investments and Gradient Investments. I'm Ollie Ludwig, the managing editor of IndexUniverse.com. We are the public face of IndexUniverse LLC, the leading authority on news and data about ETFs, and the company behind Inside ETFs, the world's biggest ETF conference. Before we get started, I'd like everyone to know that they can ask questions at any time during the webinar in the window at the lower right of your screens, and that the presentation will be available to all of you 24 to 48 hours following today's webinar. Joining me today are Bill Belden of Guggenheim Investments and Wayne Schmidt of Gradient Investments. Bill Belden is a managing director and head of product development at Guggenheim. He has direct oversight over mutual funds, closed-end funds, ETFs, variable annuities, and product strategy. Bill has long had a very central role in Guggenheim's ETF operation, so he is a very esteemed guest indeed. Joining Bill is Wayne Schmidt. He is the Chief Investment Officer of Gradient Investments. They are based in the Twin Cities in Minnesota. Wayne has more than 2.5 decades of institutional experience and in-depth knowledge of the private client market, offering a global investment management perspective. Now, Guggenheim is the 8th biggest U.S. ETF company. It has more than $15 billion in assets under management, and more than $2 billion of those assets are in its two families of bullet shares target date maturity corporate bond ETFs. One of those families is focused on investment-grade corporates and the other on high-yield corporate credits. We definitely have a lot to talk about today. Everyone is talking about yields. They're in very sharp focus since the market crash of 2008 and 2009. And this era of financial repression has left official interest rates exceedingly low. But more to the point, it seems that this extraordinary period of quantitative easing and of Fed life support for the markets may be starting to end. And this makes the subject of rates even more pressing and important for advisors and investors. So this could scarcely be a more important question given how many baby boomers are nearing retirement at a time when bond yields are low, and even worse, if rates do go up, the possibility of capital losses loom large, particularly for holders of the traditional perpetual bond funds that are out there. So one can fairly ask the question, might this environment of rising rates be the very time that bond funds like the bullet shares that actually expire at par come out to be the perfect tools for bond investors all over the place? It seems NASDAQ thinks so. It agreed to fund what amounts to be a global expansion of the bullet shares franchise not 2 weeks ago. So with these broad brushstrokes in mind, it's my pleasure to introduce to you Bill Belden of Guggenheim Investments, and I want you to know that Bill will be turning to Wayne from time to time during the presentation to get a practitioner's perspective on the bullet shares family of target date maturity bond ETFs. Bill?
Ollie, thank you very much, and thanks to everyone who has taken some time from their afternoon today to join us for today's webinar. Today we wanted to highlight what we believe is an attractive investment solution for advisors and clients, particularly in light of the current market environment. And to help set the stage for that discussion, let's first briefly review where we are. Obviously, people have been paying a lot of attention to what's been going on in the markets over the course, in particular over the past couple of weeks, where volatility has really crept up. So we'd like to take a look at the timeliness of the defined maturity ETF space, which is our focus today, and in particular on the Guggenheim's bullet shares ETF. So when you look at the fixed income environment that we're currently operating within, where do you get returns in fixed income? Now, that area of the market is not typically the area where you're focused on for taking risk in your client portfolios. So accessing return remains a challenge, and with benign credit and still relatively low interest, increasingly volatile interest rates, where do you seek return within fixed income? The 10-year Treasury has moved up about 70 or 80 basis points just here in the past 4 to 6 weeks, and there's continued talk and speculation around what's going on with quantitative easing and the pace and amount by which the tapering may occur. So many investors expecting an interest rate increase moving forward, even beyond current levels, are uncertain as it relates to exactly how their portfolios ought to be positioned to defend against that volatility and or opportunistically take advantage of opportunities when they present themselves. Now, again, the market's at dislocation right now. One of the major effects of the QE is that there's an increased volatility, and the expectations around QE are varied to the point where we've seen dramatic interest rate and price movement. Now, one of the graphics that our Chief Investment Officer at Guggenheim Investments, Scott Meinert, has pointed to is the comparison of the movement in the 10-year Treasury yield versus the University of Michigan Consumer Confidence gauge. Now, historically, the real yield on the 10-year has closely tracked that University of Michigan Consumer Sentiment Index. The correlations broke down during the fourth quarter of 2011 as a result of the Fed's asset purchase program. Now, the yield on the 10-year would be roughly 150 basis points higher if the market was not being distorted by this type of uneconomic buying, if you will. So you certainly see the opportunity for continued interest rate volatility and potential increases in the marketplace. So again, we know that advisors and their clients are looking for solutions to, again, manage their risk exposure and take advantage of opportunities within fixed income. With that, I'd like to point to Wayne to kind of highlight, and thank you again for joining us, Wayne, but highlight some of the areas of focus for you and some of the questions you may be having to address with your clients.
Yeah, no, perfect. Thanks, Bill, and thanks for having me on the call today. Gradient Investments, we work through a network of national independent advisors, and without a doubt today, the number one concern we hear among these independent advisors and their clients is the uncertainty in the bond market, and all of a sudden in the last 6 months, the realization that you can lose money in bonds. I started in the bond market really just after the bull market and bonds started in 1981, and we're coming off this 32-year bull market, and we've had a 10-year period where stocks have underperformed bonds, and that relationship's not going to last forever. And what I found to be key is just managing investor and advisor expectations is so critical in this market. We've been telling everyone who listen that these 5 and 6% returns you've enjoyed in the bond market the last 5, 10, 15 years, they just cannot mathematically continue from here. When we started 2013, we were trying to lower people's expectations from the bond market to say, if this is an earn the coupon year, 1 to 3%, it's going to be a good year. And I think now after the first 6 months are in, if the bond market manages to produce a positive return, this is going to be a good year. And we've only had one negative year, I think 1994, in a long time. So this is going to be a challenging second half to the year, and there's a lot of uncertainty out there and a lot of people unsure of the bond market today.
Great, thanks. So that does set the stage to talk about ways or means by which advisors can take one particular approach to helping to mitigate against some of that risk that we're seeing in the market. So I think everyone would agree that investors should develop a sustainable long-term strategy to approach their exposure, their allocations within fixed income. And fortunately, recent developments in ETFs have provided investors with a new tool to position their portfolios in both in anticipation of and in reaction to some of this interest rate volatility that we're seeing in the marketplace. So again, I still talk about that as a recent development when, in fact, we're coming upon or just have passed about 3 years in terms of the life of defined maturity ETFs being introduced into the marketplace. Still relatively recent, but again, what defined maturity ETFs are is a structural innovation in the marketplace that deliver a specified maturity date to investors. So when Guggenheim came out with defined maturity ETFs, we worked in collaboration with Accretive Asset Management, and Ali had earlier mentioned the recent partnership that Accretive announced with NASDAQ. But Accretive and Guggenheim worked back in 2010 on a product structure that would provide this defined maturity ETF and give what is intended to be the best of fixed income exposure, wedding the benefits of individual bonds and fixed income mutual funds. And what those products actually provide are a source of monthly income, and most uniquely or most attractive as far as the feature or facet of the product is the final distribution at maturity. So in contrast to other fixed income alternatives, whether they be individual bonds or portfolios, the defined maturity ETF provides a hybrid in terms of the benefit or the value proposition associated with each of those vehicles. So taking a little bit deeper, yeah, please do.
Oh, I was just going to chime in there too, Bill. I've spent most of my career on the institutional side, and really with the Guggenheim bullet shares, which we're going to talk about in more detail today, and in my opinion has gone a long way to leveling the playing field between being an institutional investor and the retail investor. And, for us a year ago, we were looking for those investment opportunities and strategies that would help protect clients against what we saw, this inevitable rise in interest rates. And through these ETFs, the Guggenheim bullet shares, that ability to own a liquid, diversified portfolio of credit bonds, and now adding this defined maturity date is really a powerful tool for the individual investor. We've been trying to shorten the duration of our portfolios and adding yield through credit. And this is a great defensive strategy, I think, in the type of bond market that we're in right now. And it really puts the individual investor, I think, on that level playing field with the institutional investor.
Good, thanks. So let's pull back the covers a little bit on structure and mechanics for these defined maturity ETFs and the Guggenheim bullet shares ETFs in particular. So what does each fund consist of? Well, it consists of an underlying portfolio of bonds that have the same annual maturity date. And what I mean by that is that all of the bonds in the portfolio will have maturity dates that align in individual calendar years, whether they be 2013 through 2020 for the investment grade suite of bullet shares ETFs, or 2013 to 2018 for our high yield portfolio of bullet shares ETFs. And so that represents 8 different funds, or 6 different funds in the case of the high yield portfolio. So 14 total funds, and again, each one of those funds holds the bonds that mature in that particular corresponding year. Now, what the performance of that portfolio seeks to track is an index that's comprised of the bonds that mature or are anticipated to be called, which is an aspect of the high yield that everyone should note, in the same year as the fund's maturity. And what happens at the end of that maturity? Well, investors are paid back the net asset value at maturity date, and that maturity date is the last business day of the calendar year. So that kind of gets to the mechanics of the ETF itself. And so when we compare and contrast, how does this fund or these funds compare against a 5-year corporate bond, for example, as represented here on slide number 7? And, if you look at them in comparison to each other, a 5-year corporate bond is going to provide, 5 years of income and return the potential for the return of the bond's par value at maturity date. The defined maturity ETF seeks to replicate that experience by providing, 5 years of income, and now notably that 5 years of income is delivered via monthly dividend payments. So in contrast to that bond, which is typically paying a semi-annual coupon, the defined maturity ETF is going to pay a monthly dividend. And then at the end of that life, i.e. when the fund matures off, as I mentioned a moment ago, the fund pays out that net asset value at maturity, and those proceeds are returned to investors. Visualizing on slide number 8 what happens during the course of a fund's actual termination or maturity year. Well, as of the bonds in the underlying portfolio mature, the proceeds are reinvested into cash equivalents. So through the course of that maturity year, the cash equivalents accumulate in the fund, and then as that fund matures, again, on the last business day of the year, the net assets are distributed to shareholders. So again, assuming that each one of those bonds matures and returns principal, that principal is reinvested into cash equivalents, and then those cash equivalents are maintained in the fund until the fund matures at the end of the year. Now, if you provide a comparison of the benefits of defined maturity ETFs versus traditional fixed income ETFs or fixed income mutual funds, and finally individual bonds, you'll see, on slide 9 that the benefits associated with the defined maturity ETFs are broad and certainly provide some fill for gaps that you experience by owning some of these other alternative vehicles. For example, like a bond, it has a final distribution at maturity, unlike traditional fixed income ETFs or mutual funds. The enhanced bond exposure basically is a proxy for diversification benefits that you realize by owning, a defined maturity ETF or other packaged product. The benefits of an exchange-traded wrapper, i.e. liquidity and transparency associated with the ETFs, are obviously a part of this as well. So certainly that provides selective advantages in comparison to traditional fixed income funds and certainly individual bonds. The customization that you can use with the defined maturity ETFs, which apply to that individual nature of the calendar year or that maturity profile for each individual fund, allows you to build laddered portfolios, for example, or to otherwise construct an allocation within fixed income that gives very precise components to both your duration and your yield targets. The ease of use and the access to the ETFs are particularly attractive within defined maturity ETFs. I think, as many of you may know, increasingly the ability to source bonds is very difficult. The amount of outstanding individual bonds has diminished, and we certainly have several conversations with our clients about some of the challenges that they face when they're just trying to go out and get access to individual bonds. So that access and ease of use for the ETF is particularly attractive, particularly in light of the fact that if you look at the full cost of acquisition with individual bonds, it can be pretty hefty. And these bullet shares ETFs trade very efficiently. We can touch upon that in a little bit. And when they're priced at 24 basis points for the investment grade and 42 basis points for the high yield portfolios, provide very efficient access in terms of cost of ownership. And then lastly, for professional portfolio management, certainly what I think everyone should be aware of is that every fixed income ETF in the marketplace is an optimized portfolio. There aren't any fixed income ETFs that are fully replicated in terms of owning all of the underlying bonds at the exact proportions that the index is constructed. So there certainly is a level of professional portfolio management that delivers an optimized portfolio which seeks to provide that level of income and a level of return profile consistent with the underlying index in the case of ETFs.
Yeah, and the point that Bill makes here, and it's on the chart, but it really is this product, and we're an active user of the Bullet Shares ETF, but it really gives you the best of all worlds, and especially when you look at the retail client and being able to give them the diversified portfolio and that final distribution at maturity. And, that professional portfolio management from Guggenheim, they have the research staff and the people. They're managing tens of billions of dollars of fixed income, and I think there's some credits on their do not buy list that's internal. They're not going to buy those credits in the ETF, and that's one of the things we look for when we're looking at these fixed income ETFs is what type of oversight is there, from the provider like a Guggenheim, and we have comfort in the fact that there are the research people and resources behind an ETF like this.
Bill, this is Ollie. A quick question. I want to make sure I grasp what you meant by customization before you go on. If you can just review that really quickly, just so I'm very clear on what you're talking about there.
Yeah, so, by customization, really what we're talking about is the ability to utilize the individual funds, again, keeping in mind that we have 8 funds in investment grade and we have 6 funds in high yield, and the ability to use those to fill specific needs or customize a solution for an investor's fixed income allocation. And I touched upon the fact that one of those, which we'll get into in a moment, is, laddering, for example. So you can create an exposure for a client client that provides a 3-year ladder or a 5-year ladder that's very specific to that particular customer's needs, whereas in contrast to traditional fixed income ETFs or mutual funds, you're more challenged to provide that level of customization that is very specific to the investor's needs, whether they be for planning for life events or whether they be for hedging against other fixed income exposure that they have elsewhere in their portfolio. So that's what I'm pointing to in terms of that customization reference, Ali.
Thank you.
Sure. Now, touching upon on slide 10, we provide the number of bonds that are actually held within each one of the underlying bullet shares ETFs. So that benefit statement that we talked about in terms of enhanced bond exposure represented through the diversification within each one of these portfolios provides you a good representation of how diverse the actual underlying are. The statistics shown on this page are as of the end of 2012. I can tell you that since then, each of the holdings within the ETF has grown. In other words, the number of securities held in each one of the ETFs has grown, with the exception of the two 2013 portfolios, which, as you would know or expect, as they are in their maturity year, the number of funds, or rather number of bonds in each one of those has fallen off as more and more bonds are maturing.
And this is very important, I think, on that one chart there too, Bill. It's just the thing that makes me the most nervous when I see client statements that come in and we're thinking about doing business with them and talking through their portfolio, and they show a portfolio of 100,000 and they own 5 individual bonds, and I just kind of cringe thinking, oh, that's just not enough diversification if one of those goes bad. In here, especially in the high yield area and the investment grade, that you're getting the kind of diversification here in names, I think is so important for the individual investor, because now they can get the diversification that their bond portfolio really needs. And owning 5 individual bonds that equal 100,000 where nobody did any credit research and they really don't understand those credits, it's a world away from what's here in the ETF.
Okay, good. So if we move on to slide 11 here, which highlights some of the best practices that we talk about, and both proactively and in response to some of our advisor conversations about ways in which the bullet shares ETFs can be used within client portfolios. Again, having that type of, number one, transparency in the index, and you know exactly what you own, you know exactly what the duration exposure is, because each fund corresponds to the calendar year that's titled in the name of the product in terms of its maturity schedule. So if you talk about optimal tools that can be utilized to create bond ladders, for example, I'd be hard-pressed short of using individual bonds to find a better solution, and in many cases the bullet shares ETFs are superior solutions for that because of just what Wayne touched upon in terms of diversification, ease of use. Really we see a lot of adoption of the bullet shares ETFs in ladder portfolios, and I would also add that this year even we've seen, probably in percentage terms, some of the most significant growth in the later dated maturities, as a byproduct of their use within laddered portfolios. So something you wouldn't necessarily expect to see in light of what's going on with interest rates, but we're really seeing a lot of those funds grow, through the use of or implementation of laddered portfolios. I'd also touched upon a little bit of how the bullet shares ETF can fill in gaps within existing portfolios, whether it's, to serve a transition purpose where a bond rolls off and those proceeds are going to be used for something else, but you want to maintain an exposure, whether it's, bonds are rolling off and, you have some sort of temporary use that you want to keep the proceeds invested within a particular maturity, or you want to shift that up. The bullet shares are great tools for that. They're great to, quote-unquote, equitization, if you will, for a bond portfolio, even if you're using predominantly individual bonds, or for smaller accounts within your business. They can, fill in gaps within existing portfolios and provide a complement to what otherwise might be a shifting exposure in another ETF or another, bond mutual fund, for example. Naturally, one of the biggest uses of bonds is to manage future cash flow needs, and it's nice to know that the defined maturity aspect of the bullet shares ETF supports the fact that you're going to get that NAV back at maturity. So whether you're planning for your child's education or for retirement or buying real estate or a car, I've got 4 kids that are in the education pipeline, squarely in the education pipeline, and bullet shares ETFs, that defined maturity aspect of them certainly supports that need. And then, lastly, I'd say, obtain a targeted yield curve exposure. So I touched upon that briefly a moment ago. If the rest of your fixed income portfolio is exposed in any particular area of the curve that overweights you there, then, the bullet shares are a great way to tilt that scale, if you will, or to provide greater balance to what your desired yield curve exposure might be. And if implementation is a lot easier by using a bullet shares ETF as opposed to some other product that might be more difficult to get into or out of, or may have different expectations or uncertainty associated with the use of that product, then certainly bullet shares provide a nice solution there. So, Wayne, maybe could you expand for a moment a little bit on how you're utilizing bullet shares within your client portfolios?
Yeah, no, I'd be happy to. And the way we started really was the idea of, having a bond ladder as being a great investment solution to many of our clients. And you talked about funding tuition, and, we've used it. There's clients that want to take an early withdrawal from their IRA money, where they've done a 52T and set up that they're going to take that systematic withdrawal over a 5-year period. The bond ladder has been great for that. So there's as many solutions that people have, the bond ladder can solve, as it brings in that, managing that future cash flow when the clients need it. And then we've also used the bond ladder as a way. We have other fixed income portfolios that would be more traditional, but we've been telling people it's, hey, a way to shorten your duration and shorten your interest rate risk is let's go from a full-fledged fixed income portfolio into a 3-year ladder. So let's be defensive in fixed income. Let's see what happens to rates. Will they rise? And wouldn't you rather have a 3-year bond ladder than another portfolio with a 4.5 or 5 duration, and we can shorten that duration to 1.5 years and then pick up yield. And then where we add value, I think, in the process too, is looking how do we mix between those maturity years and how do we mix between investment grade and high yield. What should the right mix be on that? That's a decision that we put into the portfolio. And Bill, you touched on early, just as these unwind and as they start to roll off, there's the rolling of, we rolled our 2013 maturities out to 2016 back in April while that was still trading at a premium. So there's some, trading rules and tools that you use to help implement and help manage the client's portfolio to maximize their yield and their experience. And we've also used the bullet shares ETFs just in our fixed income as a way to get diversified high yield exposure and increase the yield of an existing bond portfolio. So all those points you have up there are well taken, and I think we've probably used all those in putting portfolio solutions together for our advisors and their clients.
Good, thanks. Yeah, moving on, obviously we started the discussion around, the volatility that exists in the marketplace today. So slide 12 provides some visuals around what's happening when interest rates are actually, moving. And I think to help set expectations or manage expectations around what's happening with yield and maturity and the fund's net asset value, people should keep in mind, what the mechanics are as it relates to the creation and redemption of shares in response or, to particular market movements. So obviously we've seen the 10-year or pretty much all rates jump over the course of the past 6 weeks or so. So, when share creation in a rising rate environment occurs, and we're certainly seeing a lot of that, the authorized participant who interacts directly with a fund would be delivering higher yielding, lower priced baskets of bonds or of cash into the fund, and we go out and acquire those higher yielding, lower priced bonds. that's going to drive the average yield of the fund's portfolio higher, and commensurately the average price of the fund's portfolio is going to drop. So, nothing surprising there. Just as with any bond, as yields go up, prices of existing bonds go down. So, we certainly have seen an increase or an uptick, if you will, in the yields on our bullet shares ETFs, and commensurately the prices have dropped a little bit over the course of the past month to 6 weeks. But from there, you see the fund's monthly distribution get higher, and that net asset value get a little bit lower. So we spent a lot of our time talking about, what's going to happen with yield to maturities. And setting yield to maturity expectations helps investors and advisors know that, this would be, based upon these assumptions, namely that you're going to reinvest at similar rates throughout the life of your ownership period, i.e. the dividends that you get paid are going to get reinvested at similar rates. The yield to maturity is an area of focus for us in terms of talking about, what the expectations ought to be for an investor who owns a bullet shares product until maturity. And I would, go on to say that it's in particularly in the case of the high yield ETFs, we go on to weighted average yield to maturity to talk about weighted average yield to worst, which is the stat that accounts for the fact that we do have callable bonds in all of the bullet shares ETFs, but they're a significant part of the high yield bullet shares indexes and then commensurately the ETFs as well. So you want to understand that a bond that is priced to call in a particular year is going to behave in a particular way as it relates to both its price and, importantly, its income payment schedule. So we talk about yield to worst in the case of the high yield ETFs as well. So we do have all that information. I would quickly add on our website. So we update our yield figures at a minimum weekly, and include our 30-day SEC yields, our distribution rates, the yield to maturity, and the yield to worst figures for all of the bullet shares ETFs. And we point people to that particular page. And we speak to actually having we do have an estimated net yield calculator as well, which can help take certain inputs in and provide an estimated net yield or with a yield to maturity figure on it for, again, managing expectations and educating people about buying into the bullet shares ETFs at any particular time. Now, one of the biggest questions we get is, what happens when these funds roll off or mature? And Ali alluded to the fact earlier that we have in fact matured 3 of the bullet shares ETFs. We've done 2 of the investment grade, the 2011 and the 2012 portfolios, and we did our first high yield portfolio last year, end of 2012. So a case study on the 2012 experience was that as each fund approaches maturity naturally, and as bonds mature off and are maintained within cash equivalents in the portfolio, the duration has moved lower and moves lower, helping to further minimize any interest rate volatility. Naturally on the heels of that, the yield would start to drop somewhat in line with lower interest rates associated with a higher cash allocation. Upon that maturity, the respective fund's NAV gets distributed to shareholders. We're fortunate enough to see a lot of that money come back into the bullet shares post-distribution, but it's just sent straight to shareholders. You would look to get it credited to the client's account. And again, we hope to see it come back, and we have seen it come back the past couple of Januaries in many instances, but it's certainly at the discretion of the investor to choose what they want to do with those proceeds. So certainly the bullet shares provide a high degree of flexibility and diversification that aren't as readily available through an allocation to individual bonds. Specifically, people look to, the price movement of the portfolio as the maturity approaches. And here's the 2012 investment grade portfolio and a graphical representation of, what happened with its net asset value as it approached its maturity date. And you can see there on the slide, it's the darker line, the purple line there that shows a nice NAV stability throughout the course of its maturity year. And, so it doesn't go back, if you will, as more and more of bond proceeds are reinvested in cash, you don't see that dramatic NAV drop-off as duration, represented by the blue line there, more quickly approaches zero. So that's primarily a byproduct of the way that premiums, in the case of this particular product, amortize and provide a stability to the net asset value, which I think is appealing to investors who continue to hold the fund throughout the entirety of the maturity year. And if you can see there, it's kind of in small print on the left-hand side. You can look at the final NAV for the BSCC, which is that 2012 investment-grade portfolio, was just over $20.45. We issued that fund at inception at $20, so a good experience for shareholders who held that fund. And certainly the other two portfolios that I mentioned that we have rolled off had similar experiences, including the high yield that matured at the end of 2012. By the way, the same information as far as the actual amounts of the proceeds and last distributions are also included on the Guggenheim Investments website in the bullet share section, should you choose to be interested in that detail. I think slide 15 begins to summarize what the value proposition actually is for the Guggenheim Bullet Shares ETFs. So we've talked a lot about what the idea was behind the creating the Bullet Shares ETFs and the indexes that underlie them, and the value that we've delivered to clients. And so we rolled our first investment-grade Bullet Shares out in June of 2010, and followed that with the high-yield Bullet Shares in January of 2011. So as we find ourselves now, roughly 3 years later and about 2.6 plus billion in AUM later, I think we've got strong interest shown, and as more education gets out there about what the bullet shares are, how they operate, and most importantly how they've delivered to clients, i.e. doing what they said they were going to do, we continue to see great interest in the ETF. So if you look at the benefits that they provide in terms of that wedding of owning bond mutual funds or bond ETFs, or a individual bond itself with a monthly income and a defined maturity at the end, we certainly feel like these are very well positioned to continue to provide value to clients in what has become a much more volatile interest rate environment even than we've seen over the course of the past couple of years.
I'd agree with all that, Bill, that you say there. And, I see individual bonds for individuals to buy those bonds. They're easy to buy. They're easy for somebody to sell them to you. It doesn't become a problem until you want to get a bid for those bonds and try to get them sold, right. And you find out, well, I'm selling that 2 points below, maybe fair value, because that's what somebody's willing to pay for a odd lot piece. But here, with the ETF, and, some days are, penny bid-ask spread, some days it's 2, but, there's good liquidity, and, using limit orders, and we do that for all these, but you can go in and see that there's good liquidity, and if people, for whatever reason, want out, they can get out without the horror stories that you get when you start getting involved in trying to liquidate odd lot pieces of individual bonds. So that liquidity is really key.
Yeah, great. That is a very important point to hit on. So on slide 16, you see the list of the existing, 8 investment-grade bullet shares ETFs and the corresponding tickers and the 6 high yield. I will say that we have additional maturities that are in registration. As a coming attraction, look for an announcement on the scheduled launches for some additional maturities within both of those suites. So we're excited to continue to focus on extending those product lines, and we're actually doing some, we're very actively engaged in R&D work on seeing where else within fixed income we can add value to the fixed income marketplace via the bullet shares structure. I'll close with the prepared part of today's webinar by just pointing to the Guggenheim ETF Knowledge Center, which is our group of individuals who are educated with all of the details surrounding all of our ETFs, and in particular the bullet shares, who have access to a wide range of tools and can help you with basic to more complex inquiries, both in terms of the underlying indexes, the ETFs themselves. And certainly we have a best execution desk that is ready and waiting for any inquiries on on ways in which you can make sure that you're more efficient in terms of your execution around any of the Guggenheim ETFs, and in particular the bullet shares ETF. So with that, Ollie, I think that wraps the prepared comments. Would you care to kind of queue up any questions?
Oh, absolutely, Bill. Thank you very much, gentlemen. And as I expected going into this, there are a lot of questions here and a lot of really good ones. Some are very rudimentary and some are much more sophisticated, and I'm going to run the gamut because I think everyone needs to know about these products. They are different. They are new. Let me just start with question about trading. There's always a lot of talk about trading. The more people get to know ETFs, the more they realize they aren't really stocks, even though people do compare ETFs to stocks in terms of trading. So I'm wondering if, Bill, you might offer some very specific insight as to what it is about these bullet shares that might be distinct in terms of trading them correctly in the traffic.
Yeah, thanks. I think that, I would build upon Wayne's earlier comments in terms of what we talk about all the time related to execution of ETF trades, whether they be bullet shares or any other ETF, and that is we do point to the use of limit orders to ensure execution occurring around, where you want it to occur and where you need it to occur, in lieu of market orders, which, like any other security, can sometimes be punitive where the trades actually get executed. So limit orders are a key aspect of execution that we feel are certainly one of the ways in which the bullet shares can be executed most efficiently, and frankly that goes for any ETF. More granularly speaking, on the bullet shares ETFs, we would really point people to take a look at where pricing exists within the products at any time that you're looking to establish that limit order price. So it's not uncommon for fixed income ETFs or any ETFs from time to time to trade at premiums or even in some cases at discounts, and being mindful of basis points being very important. You want to make sure that when you're looking to set that limit order price, that the price that you're setting it at is consistent with where you want it to be in relation to the fund's IIV, i.e. the pricing of the fund's underlying portfolio, so that you can make sure that your execution isn't too far afield from where that IIV actually is. I would quickly add to that, however, that our experience with bullet shares and pricing in those is very reassuring. I mean, we've seen great efficiency and tight pricing around the bullet shares ETF. We have a number of market makers who are making markets, and the more market makers you have out there, the greater the efficiency associated with execution. We have a number of authorized participants, a great number of authorized participants who are transacting in the bullet shares ETF. So again, we're very pleased with where pricing support actually exists for the bullet shares ETF. But again, the takeaways are: one, limit orders; two, take a look at where the pricing exists when you set that limit order to make sure it's where it should be in your eyes relative to where the IIV actually is. I'd invite.
And one of the things we do every day too is go to your website and look that we find out what was last night's NAV. We kind of know what the bond market's doing, maybe what spreads are doing, and we can kind of get to what is too much of a premium, or what's a fair premium, to set that limit order is important. And we've been, bringing accounts in smaller pieces, so a lot of my purchases are not of a size that would cause a disruption in the market. Maybe I'm buying 1,000 shares or 500 shares or 1,500 shares, but it's on an account-by-account basis, and we've inquired as we want to roll, and that'll be a bigger issue later in early 2014, is getting that institutional help of being able to do a large block trade. And we've talked with the people at Guggenheim, they're the technical people, and they've put us in touch with some market makers on those securities. So we haven't crossed that bridge yet of trading in large bulk, but that's coming.
Thank you very much. That's interesting to hear your perspective there, Wayne. I'm going to just ask a couple of questions of my own and then quickly go to the audience because, as I said a moment ago, good questions. One of the things that caught my eye, I think it was slide number 10. You were talking about the number of holdings in each of the distinct maturity years, and the numbers were not consistent across that the yield curve there. And I'm wondering why that's the case, because that essentially implies that your diversification benefit is not a constant. Is that correct?
Yeah, I think, there's a couple of things that drive that. Number one, it's the number of bonds that are in the underlying index, too. So in many cases, you'll see issuance in particular calendar years that is, higher versus other calendar years. So you see the 2015 and the 2017s have more bonds on the investment grade side than elsewhere. So the first thing you would point to is, what is the number of bonds that's in the outstanding index, which again is a byproduct of the methodology itself. Within each of the funds themselves, as I mentioned, we go through an optimization process whereby we look at the risk and the return and diversification and elements of the underlying index, and then we construct a model portfolio that's designed to behave in a similar fashion. And so, each one of these numbers that are associated with that optimized portfolio produces an investment profile for the underlying fund that is designed to do that. And whether or not that's 172 bonds or 105 bonds, that's where we feel the fund itself is best positioned to deliver upon that profile. I would also add that if you take a look at at slide 10, which we have up there, and you look at the last three maturities in each of the fund families, we rolled those out last year in 2012. And as those funds have continued to grow their AUM, the number of bonds has continued to grow, because certainly as greater efficiency for us in terms of executing on trades and adding bonds to the portfolio grows, our ability to effectively track the index grows with, in appropriate instances, increases in the number of bonds that are associated with each of the underlying funds. So there are a couple of aspects of that I think find their way into the number of bonds that are within each one of the funds. And as I mentioned earlier during the prepared comments, for every one of those funds, the actual number of bonds has grown since the end of 2012 to where we are as of yesterday, with the exception of those 2013 funds, which, as you know, are experiencing bonds maturing. So I hope that helped, Ollie.
Yeah, okay, thanks. One other question, the journalist traveling in the traffic, I've taken interest in these bullet shares funds. They really do strike me as something new and something that advisors really should know about, and they can make their own decisions once they take full measure of these things. But one of the things I keep hearing from people, you do have the proof of concept now. You have 3 in the bag, right? 2 from the investment grade family, 1 from the high grade family, so that's all good. And yet there's this persistent kind of line of questioning that I keep encountering, that what would happen to this whole nicely orchestrated maturity of these funds and closing of the funds if the market became very dislocated the way it was in the autumn of 2008? Can you sort of go there? I don't mean to be alarmist, but this is a question I keep hearing, so I wanted to hear you speak to how you see that.
Yeah, sure. I think it's a very legitimate question, and it's one that we have a lot of conversations around. And the first thing that I would point out too is that the risks associated with owning these funds are similar to the risks of owning the underlying bonds in many cases as well too. So you certainly, when you see volatility in the marketplace or dislocation in terms of pricing, you'll see an uptick in the volatility of pricing in the underlying as well. Remember that the NAV for the fund is primarily a byproduct of the pricing in the underlying bond. So when you own a high yield product, you take on the risk of owning high yield of securities that have that exposure to high yield, which obviously are heightened relative to their investment grade brethren. But getting more specifically focused on the aspects of these products being ETFs in an environment where, as you mentioned, in 2008, we saw a pretty dramatic price dislocation happen in the markets, and I think that if an event like that happened again, or an experience happened like that again, we saw pricing, deteriorate as it relates to, the spreads in the market. We felt like in 2008, while bullet shares weren't out, we felt pretty good about, the remainder of our ETF pricing pretty efficiently and being there for execution. And so people who wanted to sell their ETFs could do that, and we don't believe bullet shares are any different in that regard, and that we do have a number of market makers making markets in the ETFs, and when greater stress is applied to the marketplace, it's not uncommon to see spreads widen a little bit. But we feel pretty comfortable that most of the market makers that are in there remain in there consistently through ebbs and flows as it relates to what's going on in pricing. And again, just using the past 6 weeks, for example, while not anywhere near to what the 2008 experience was, nonetheless have provided, I think, some anecdotal observations about what's happening there. And we're very confident with the way the funds have priced and the experience that investors have had for those who have chosen to get out of and into the fund. So that also invites one other observation that I would provide, which is in the history of the bullet shares ETF, we've never had a high yield redemption. So people see the headlines, on IU and elsewhere around what's happening with other high yield ETFs and other high yield products. And we haven't experienced a single redemption in the high-yield suite. And in the investment-grade suite, we've only experienced one in their 3+ year history. So I think
which is to say that these have they're pretty sticky assets relative to perpetual bond funds, right? That's what you're saying, essentially?
Yeah, I mean, I think anyone would be hard-pressed, or I'd challenge anyone to provide, another ETF that has had the same experience where they haven't had a single or only one redemption in their history. And I think it does evidence the use of the ETF being primarily applied by buy-and-hold investors. As I think mentioned to you before, Ali, and others, I mean, I'd certainly welcome, greater two-way flow, and we were very happy with the volume that we see in there because it means that they're getting used for other things. But our experience to date has been that, primary consumption of the bullet shares ETFs has been for buy and hold purposes, and we have not seen that volatility. But again, I think it points to, what happens in the case of, for whatever reason, people want to start selling the ETFs, and we do start to experience some redemptions. Well, we have the ability, and ETFs transact on an in-kind basis primarily. So when, we got an order for a redemption, we could either support that via a cash redemption to the authorized participant, or we could do it on an in-kind basis.
Allow me to interrupt really quick. There is a very germane audience question here to that very point. One of our audience members has asked, how much cash do you have on hold for liquidity for redemptions?
Well, keep in mind that the purpose of the fund is to track the performance of the underlying index. So to the extent that, we're modeling the optimized portfolio to deliver that performance that aligns with an index which in and of itself doesn't contain cash, we are, generally pretty fully invested, but, typically because of the nature of the ETF and the movement in there, we'll probably have 2 to 4% cash in the portfolio to support, any immediate redemptions. But again, I can't reemphasize or emphasize enough that, we can or are in position to deliver redemptions on an in-kind basis to the authorized participant, Ollie, and I think that it's important to maybe to spend a moment talking about that authorized participant who basically serves primarily as a facilitator between those who are transacting on the exchange and the fund itself, right? So all the people who are dialed into this webinar are buying shares off of the exchange primarily. And and with that, that supply and demand of shares in that inventory as it grows or decreases is basically managed by these authorized participants, institutional shareholders authorized to transact directly with the fund, and they transact with the fund either on an in-kind basis by giving securities to the fund in exchange for shares, or by giving cash to the fund, and we go out and buy the securities ourselves. And when we do that, we charge them a fee for going out and buying the securities as opposed to having them deliver them to us, because we want to make sure that the shareholder base is protected and not incurring any fees that wouldn't otherwise be encountered by the transacting on an in-kind basis. And the same goes for redemptions. So that authorized participant, if they come to us with a redemption request, if they want to take it on an in-kind basis, that's great. We'll give them the bonds. If they want to take it on a cash basis, then typically what would happen is we'd again charge a fee to cover the expected transaction costs of selling those bonds ourselves before we delivered the cash to the authorized participant. But none of that in-kind activity happens at the investor level, at the ultimate investor level who's buying and selling shares on the exchange. That only is happening with authorized participants.
Right. Now, a lot of questions, so little time left. One question, these are going to get a little more granular here, and then I'll pull back at the end with the question about your competition.
Sure.
In any calendar year, why not simply refund the principal balance as it occurs as opposed to reinvesting to the end of the year in a money market fund that is earning nothing right now?
You mean in terms of like just pay out the
yeah,
proceeds
that's
the bonds mature in?
That's what the question seems to be touching on, yes.
Yeah, I think that that's a fair question. I think we'd be challenged to really effectively do that. We have, unit investment trusts that pay out proceeds on bonds as they mature off within the portfolio. But to find a maturity ETF really, I think, is designed to behave in a way that, again, emulates the behavior of an individual bond. And it's difficult to be taking on individual purchases, creation units, redemptions should they come, and keep this product continuously offered and managed throughout its life if you're taking bonds in and immediately selling them back out as they mature. So I think for both clarity of concept and implementation, as well as staying true to what the objective of the fund is, which is to emulate as many of those bond-like characteristics as we can, we feel like we're better served to keep that cash and cash equivalents to support activity in the fund until its termination or maturity date at the end of the year.
Got it. Okay, I'm going to move right along here. Great questions, and we have so little time. How does this compare to using strip treasuries for bond laddering, the overall bullet shares family?
Wayne, could I ask you to kind of jump in on that?
Yeah, I'd say with the strip treasury, if you were to use that, obviously you have a government security and the quality of that, and you have a specific date that you're going to get par at, and whether that's 2 years from now or 20 years from now, specifically. Here, like Bill said, you're getting the distribution of the NAV, and there's a little bit of unknown built into that because you have the fact that some of these bonds are callable. Maybe they don't get called. Guggenheim has to buy them back at the market price. So there's a little bit more, there's more variables in the ETF than there would be in a zero coupon strip treasury. Exactly. The zero coupon ETF or the zero coupon treasury, you don't get any cash flow over the time you own that. Where here, this pays a nice monthly dividend out with that. So those would be the major differences, I guess, with the zero coupon treasury. You get that exact date and amount that you're going to get at maturity. In here, there's a little bit of unknown as to exactly what that amount will be.
Okay, thank you.
Now, is that fair, Bill?
Yes, thank you.
Okay.
Now, imitation is the sincerest form of flattery. iShares has arrived with their term maturity ETFs. We have a question about how this has affected flows into bullet shares. That may be germane to liquidity and trading these bullet shares ETFs. Moreover, iShares is competing on price. There was a question about how much do they cost. I think, Bill, you said your investment grade costs 24 basis points a year. The high yield costs 42, and the iShares suite is coming in at 10 basis points. I believe you've indicated to me, Bill, that you would compete on price. Tell me a little bit what the reaction is at Guggenheim to what's going on over in San Francisco with iShares rolling out these products.
iShares. Who's that again, Holly?
I'm sorry?
I'm only kidding. I was just joking about iShares for a second. I think, iShares came out in the market with a version of their investment-grade corporate ETFs a couple of months ago that, certainly had some very notable nuances in terms of portfolio construction. So they aren't exactly like the bullet shares in terms of what they deliver. They don't have financials exposure, for example, and they mature on a different schedule than what the bullet shares mature on. So I think that, from the actual what you get for that investment is where I would start on that, and there are some notable distinctions there. They have subsequently filed for some, additional corporate bond ETFs that are probably a little more analogous to what the bullet shares consist of, and certainly they want to be aggressive on price. And as I've said to you, we certainly view that as a competitive landscape that we intend to be competitive within, and we certainly feel like we have established a nice penetration and within the marketplace and an understanding of what the bullet shares defined maturity ETFs actually deliver, and the value that we've provided, and I believe we continue to provide around education and most importantly the results to clients, I think validate the concept as you mentioned earlier, and I think that the way that we're priced currently is something that I'm very comfortable with for the value proposition that shareholders are actually receiving. But we always have our finger on the pulse, and if and when changes are appropriate for us, we'll be very proactive in communicating those and taking those actions. One other point I would just highlight is that we have 8 consecutive years for investment grade, and we're looking to extend those out in the very near term here. And we have 6 years in high yield. We're going to be similarly extending those out. The iShares products right now only have, I believe that they're 3, 5, and 7 years, or 3, 5, and 10 years in terms of where they actually exist in terms of the years that they're covering. So they're really not ideal for many of the uses that we talk about for the bullet shares ETF, like, for example, bond laddering. So
Understood. All right. Well, I hate to cut you off, Bill and Wayne, but we have run out of time, and the many left on the table, so apologize about that, but a lot of great questions. That concludes our Expert Series webinar on Fixed Income in Focus, Rising Rates, Misconceptions, and Solutions. Bill and Wayne, again, I want to thank you for being my guests, and I want to thank the audience for coming up with some great questions. Please remember also, as I said at the beginning, that this presentation and the deck of slides will be available to you within 24 to 48 hours. So on that note, on behalf of all my guests from Guggenheim and Gradient and my colleagues here at IndexUniverse, I'm Ollie Ludwig, wishing you all a very pleasant afternoon.